Hello friends, today we are going to discuss a very interesting subject, and that is learning from mistakes in investment decisions. Friends, we make mistake in the course of performing our duties, but at the same time we have to learn from mistakes for our future actions. As you know that Warren Buffett is the all-time biggest investors in the equity, even today. But we have identified 6 common mistakes he also did during his investment decisions. These all informations we have gathered from his various lectures, writings, statements, etc. Which are those 6 common mistakes? Number 1, buying shares at a wrong price. Generally, there is a tendency for all investors, whenever they find the market is going to the upper circuit, they feel it is the high time to buy the shares so that they can get the benefit of the upper circuit. It does not happen all the time. So you have to find out the intrinsic value of the share and then go for acquisition. Sometimes buying shares at a higher value could be fatal for investments. So be careful about the pricing part. Second most important is do not bring your personal emotions, feelings in investment decisions. If you find that a particular share or a security is not performing well for a reasonable time, it is better to think to come out and to go for a better security. Many times we feel or we always hold a wishful thinking that the prices will go up and we can cover our losses. It does not happen all the times. At certain times, you have to come out and find out a better security. So second learning is never ever bring personal sentiment or emotions in investment decisions. Third, particularly this principle is applicable for acquisitions. Whenever we go for acquiring any company or buying any substantial amount of equities, we have to see the company's competitive advantage in terms of 3 areas: growth, how the company is in a position to counter the competitions, in terms of growth, in terms of profitability, in terms of return on capital employed. These are the 3 important things. So whenever you go for acquiring any new shares or new equities or go for acquisitions, you have to see which is the target company and where it stands in terms of economic growth, in terms of profitability, in terms of return on capital. This the third important area. Many times we always see the company, but we do not see its competitive advantages. Fourth, very important, that never kill your golden goose. To invest that fund in a wild card bets, which means you have a good security, it is performing well in terms of appreciation, in terms of dividend, in terms of growth. But because of some proposals, sometimes you can break the investments and put this money in a wild card bets without knowing the new company, without knowing much about the new ones. Be careful. Do not put your good money for bad investments. Fifth, many times people confuse revenue growth does not necessarily mean that the profit growth will be in the same proportion. You will find many companies which has registered a revenue growth, that is sales growth, say 20%, whereas profit growth could be 5 or 6% because of additional cost, because of cost of production is high. So turnover growth is certainly a very important issue, but it does not necessarily mean that its profit growth will be in the same proportion. Even if there is a profit growth, you may not find it in the cash flow growth. There are companies where you will find turnover has grown by 20%, profit has grown by say 22%, whereas there is a negative cash flow. Why? Because of high working capital requirement. Almost whatever profit is coming, that they are investing in book debts. So there is no enough cash flow. So profit growth or revenue growth does not necessarily mean there will be cash flow growth. Many management consultants, they only see the cash flow growth because it is the only money which is coming to the company. A company may be making huge profit, but it has a huge investments. So entire profit is going for fixed assets, book debts, stock position is going up. So therefore, do not confuse revenue growth with a successful business growth. Very important. And six, last but not the least, ignorance is not always bliss. If you don't know on any particular subject, please take the help of the consultants analysts, industrialists also take the help of internet to understand and then take a graded decisions. So therefore, ignorance should not be always a bliss. These are the 6 issues which we normally ignore and take investment decisions. So be careful. I repeat those 6 cases. Number 1, please pay the right price. Don't be greedy when others are fearful. Second, do not bring emotions in your investment decisions. Third, please see the target company and its competitive advantages in comparison to the competitors. Fourth, do not put your good money for an uncertain investments. Good money means wherein you have put your money and doing reasonably well. Do not confuse revenue growth, profit growth with the cash flow growth. Once you find there is a revenue growth, there is a profit growth, and also there is a growth in cash flow, you can identify this is a successful company. Cash flow is a very, very important. And 6th area is ignorance is not always a bliss in investment decisions. If there is any deficiency in the knowledge, please try to get it from the best available sources. These are the 6 common mistakes which we normally make, and that is why this video is made to educate the beginners, those who are interested to come to the market. Today's equity market value in India is approximately equal to country's GDP, that is 3.5 trillion US dollar or $3,500 billion. So as a responsible investor, please take cognizance of the 6 common mistakes for a eventful investment experience. Thank you very much.